This is the junkie trader. He opens his chart, sees a move and jumps right in. No plan, no levels, just emotion. He wins a few trades and feels smart. Then one fake breakout wipes it all out. A blown account later, he's back at the job that he hates, wondering why trading never works. Now compare that to the operator. He doesn't react, he waits. Before price even moves, he already knows where he's interested and where he's not. He stays detached, he follows structure, and he lets impatient traders get punished first. Same market, same charts, different outcome. Breakouts. You draw your support line, you draw your resistance line, and waiting for that one moment to happen. And when price breaks, it really breaks. But here's the problem. Most traders don't fail breakouts because they don't understand it. They simply lose money because they trade the wrong ones. So how do you usually trade breakouts successfully? How do you avoid false ones? And is there a simple way to stack the odds in your favor? And in this video, I'm going to show you exactly how to do this using support and resistance only. Let's get into it. Has this ever happened to you? You draw your support, you mark your resistance, you wait patiently, then price finally breaks above the resistance. You enter the trade immediately, excited, expecting a huge move. You sit there watching the chart and suddenly price reverses. The breakout fails, your stop loss gets hit, and your account takes a hit with it. This is what most traders experience with breakouts. But here's the thing. The breakout wasn't random, there were signs. So first, we need to answer a simple question. What actually is a breakout? A breakout happens when price has respected a support and resistance zone multiple times, meaning buyers and sellers were clearly interested in these levels. The breakout itself happens when price either pushes above or below these key zones. When this happens correctly, price usually accelerates quickly. The problem is, most people enter too early. So how do you find the high probability breakout setups? The answer is not indicators and is not prediction, it's structure. You've probably seen breakout patterns before. Rectangles, wedges, triangles, flags. But here's where most people go wrong. They look for the perfect pattern. Price almost never forms a perfect textbook shape. Instead, what actually matters are key zones. All breakout patterns have one thing in common. These are price consolidates, clear support and resistance levels, pressure build up, pressure builds, and price attempts to escape. That's it. So let me show you an example. Here, we can see price reacting multiple times at this level. Buyers step in here, sellers defend here. So we mark our support and resistance zones. So far, everything looks good. Now here's where most traders mess up. As soon as price pokes above resistance, they enter. But a breakout is not valid just because price touched above a level. What we want is commitment. This is where a false breakout pattern happens. Price briefly moves above resistance, but sellers immediately step back in and push it back down. The breakout fails. This is why waiting for confirmation really matters. So how do we confirm a real breakout? We look at how price closes relative to the resistance zone. A valid breakout usually shows one of two things: a strong close above resistance or multiple consecutive closes holding above the zone. If price only wicks above resistance and closes back inside, that's rejection, not strength, and that's a warning sign. Let's look at another example. Here, price breaks above resistance with a small candle, no follow through, so we wait. Another candle forms, still weak, so still no commitment. Then we finally see the price close clearly above the resistance zone. This tells us buyers are in control, and this is where we consider an entry. Now let's talk about risk management because this is crucial. Once we enter a confirmed breakout, our stop loss usually goes below the resistance zone. And why do we do this? It's simply because if price falls below the resistance zone, the breakout is invalid and it's a false one. It's as simple as that, no guessing. Now, instead of using indicators to take our profits, what we do is something much simpler and more logical. What we do is we look at the next resistance level because price is likely to target that area. Breakouts don't move randomly, they usually move from one zone to the next. So essentially, the next resistance zone becomes our target. This keeps expectations realistic and also removes emotion from the trade. Here's how I manage the trade. I don't aim for massive wins, I aim for clean structure moves. As price approaches the next resistance, I either take partial profit or fully exit the trade because resistance is where sellers are likely to step in again and push the price back down. That's how you avoid giving your profits back. Let's look at one more example. We mark our support, we mark our resistance, price consolidates. Price attempts to break but fails. False breakout, so we stay out. Later, price breaks again, this time with a strong close above the zone. We enter. Stop loss below resistance, target at the next resistance level, price moves clearly into that area, trade complete. No indicators, no guessing, just structure. This is exactly how you avoid false breakouts. If this helped you understand breakouts better, consider subscribing. I post more breakdowns like this regularly. Thanks for watching, I'll see you in the next one.